interpretation of financial statements. Okay? In particular, you're going to have a good understanding of the main themes that are covered and what things that we look at. Identify and interpret the accounting ratios referenced to. So we're going to look at profitability. So how do we measure profitability within the organisation? What's liquidity?
Cash.
It is cash, but when we say about liquidity in relation to ratios, can you remember what liquidity is? If I say current ratio or acid test ratio, does it ring a bell? Okay. Liquidity basically is about how stable are we in relation to an organisation. Okay. The ideal situation is that what we call the current ratio you look at later is what are our assets to our liabilities. Okay. So how many assets have we got compared to the liabilities? So we look at that to see how financially stable the organisation is. We'll talk about who's interested about that in a minute as a recap. Then we look at the use of the resources. And we talk about how efficient are we in relation to using our resources. What do you do in work, just out of interest?
Me?
Yeah.
Assist people.
Assist people with what?
All sorts. Just started doing board papers for environmental division.
Oh, right, okay. Is it interesting?
Yeah.
Is anybody involved in like credit management or anything? No? Yeah? So chasing up the debtors and things like that?
That's well.
Yeah. So what sort of policies is it for the amount of what credit limit, length of credit limit do you give? Not credit limit. What's the settlement dates? Or is it
Obviously, we've got different contracts, so depends on the contract.
Generally. Generally. 30 days, 60 days?
Some of them got 60 days, some of them 30.
Depending on the size of the organisation, isn't it? Okay, so what we do is really we can look at how efficient are we in relation to chasing up our debtors, so trade receivables. So at what length of time does it take, on average, for us to get back the money from our debtors? And then we usually look at that in relation to our trade payables. So in other words, how long does it take for us, how long do we take in paying our suppliers? Okay? And basically looking at those to make sure the ideal situation is that obviously you don't pay your suppliers before you receive the money from your customers. So it's about making sure that we manage those resources properly. We also look at stock turnover and how quickly does stock turnover within our particular organisations. Okay? And that's the things we'll be looking at as we go through the night. Okay? How efficient we're using our resources. We'll look at the trends and produce reports, because the first question on the AAT exam is where it gives you the financial statements, and you have to first of all give them the ratio. So what is the formula for the ratio? And then it will ask you to calculate the ratio. Okay, so using that formula from the financial statements, what is the ratio? What is the percentage? Or whatever. The second question, it gives you the ratios and it gives you the scenario, but then it's saying to what's happening. So what's gone on there? Draw some conclusions about what's happening. And again, I'll guide you through that as time goes by, what we need to do. Right? So how you analyse it, because then you have to produce a report about what's going on. Again, I'll guide you. I know that Jill's doing report writing with you quite soon as well. But it's about stating the obvious. What's actually happened? And what are the reasons for that? By the end of the session, you'll certainly have a good idea of what we need to do in relation to that. Okay? And then we'll identify and explain the limitations of ratio analysis. So what are the limitations of ratio analysis? I did say I'd show you sort of the plan over the next few weeks. I'll do that in a minute because I'm on the roll now, so I don't want to stop. So look at that. I have said before, for me, the difference between management accounts and financial accounts is quite simply for me. Financial accounts is about producing the financial statements, okay? Which is what I prefer the other bit, which is the management accounts. Because the management accounts is basically looking at 2 to 3 years of financial statements, because then you make decisions on it. I was sat with my senior management team this week, looking at our statistics, looking at our success rates, looking at our numbers, looking at the amount of students that we had last year, what are your plans for next year, and all of these things. So we're all looking at trends to identify where we're at. Okay, so we do it within our workplaces to identify how well we're performing or how we're not performing. so on and so forth. Okay, so we're looking into much more detail. So that's what we're looking at. Okay, so what's the point, I suppose? And I've said, question. I'm laughing because I'll explain. I asked the day group on Tuesday, I said, okay, what's the point of accounting ratios? So who wants to know about financial statements of an organisation? And I'm smiling because one of the lads in the class went, well, yeah, he said, so I'd like to know. I said, you don't. We were all laughing because he put his hand up. Who wants to? So I'd like to know. I went, what? No, I'm just asking who wants to know about the financial statement. So who does? And don't you dare put your hand up and say, no. So who wants to know? Who wants to know about the financial statements of the organisation? Who's interested? We did this before.
Would be the customers.
Customers, we discussed at the time, why would customers be interested in the financial statements of the organisation?
This one is ratio.
Sorry?
This one is for ratio.
But generally, you know, well, no, we said that customers would want to know. I'm just asking who generally would want to know about, you know, the financial statements of the organisation. We said customers the other week, and we said, why did we say customers? Remember? It was to do with warranties, and we were talking about Jessops and things like that. So, you know, that's one thing. But the key things for us. So, who's really interested in the financial statements of an organisation? Lucy, do you know?
Possibly investors.
Investors, isn't it? So, investors are going to look at basically the financial statements of the organisation, and they're going to basically determine about, should I put some money into that organisation or should I not? Okay, we'll look at that later. We'll do return on capital employed, which is about what return do I get from my investment. Okay, so shareholders, obviously the taxman will be interested to know how well you're doing your financial statement. So therefore, because then they can work out what your tax bill, so on and so forth. So investors, then you've got internal as well, because you want to know what's going on. So we'll look at the different organisations and the different indicators we're going along. So okay, so the key thing for us is looking at profitability, and these are the things we'll look at. So the relationship between profit, revenue, assets, equity and capital employed. Sometimes about how well do we use our resources to generate revenue. What is our profitability? And then so on and so forth. And then we look at liquidity, as I said before. So the stability of the company on a short-term basis. So how safe, as an investor, if I look at their ratios and I look at their, I'll say working, it just looks out of mind for me. I'll say the acid test ratio, because that's good. The acid test ratio, where we're looking at is what are our assets to liabilities again, and I said working capital and things. It's basically how safe are we in relation to putting money in. I'll rephrase the question. Would it be advisable to put money into an organisation if their liabilities are more than their assets? Why? If the liabilities are more, well, not the assets are. Which is basically saying that
the profits, they are unlikely to make profits.
Well, it's more so the fact that, there's a good chance I might lose my money. Because if the creditors say, right, I want my money back, it's like, I've not got enough. I've not got enough assets to pay you back. So we look at, it's current ratios. We're looking at how safe the assets are. We'll do it in a bit, but the ideal situation for your current ratio is 2 to 1. So twice as many assets as liabilities. If it's the other way around, then it means that it's say 1 to 2, and oops, it's not safe to put your money into those times. So we'll look at that later. How we look at the effective and efficient use of assets and resources and liabilities. And then we look at the way the company has been financed. So how are they financed? So we look at interest cover. So in other words, in relation to the finance costs and the profit that they're making, how many times can they afford to pay back the interest? Is it safe? The amount of money they're making to cover the interest payment. And then we look at gearing. I might have mentioned before, have you heard of the gearing ratio before? Or gearing? Gearing is basically looking at, is the company based on debt? I think Manchester United is probably one of those, like a lot of the football clubs. If you look at the financial statements, it's really, really financed on debt. Yeah? Insofar as that, they usually say that we used to work up on the basis of about 40 to 50% gearing ratio. It means that it's half it's half run on debt. The higher the ratio, the more indebted the business is. So a company with a high gearing ratio means, so let's say 60% gearing ratio means the company is run 60% on debt. Yeah. So again, it's not really advisable to invest in that company because you don't know what's going to happen. There are so many other factors that can affect it. Okay. So without further ado, we'll go on and start doing some of the profitability ratios and things. Okay. So I was saying before that basically in relation to looking at trends and stars like 2 years, which we'll be looking at tonight, and we'll look at the trends in relation to what's gone on from year to year. We can look at the benchmarks against similar companies in the same industry. So we're looking to see how well we're doing overall. Was it on the news this morning? I forget mixed up. We've got Lidl and we've got Aldi. Is it Netto were on the news this morning? Because Netto pulled out of this country a few years ago, but now they've come back because they reckon there's a good opportunity to get into that market share. I think it's in Germany, I was saying last week, where Aldi and Netto, and Aldi and Lidl have got about 45% of the market within Germany, whereas in this country it's about 13-14%. So there's growth for these supermarkets that basically do it on price and quality. Okay, so what they're saying is they're going to come into the marketplace because they reckon there's good opportunities and there's opportunities for them to grow. Funny enough, it's owned by Sainsbury's, so Sainsbury's have bought it and they've gone under the Netto brand. What's it in Poland? What's the big supermarkets?
Don't ask me.
Don't know? Can't remember.
It's changing all the time. So what was 9 years ago, it's changing all the time.
Did Tesco's and all those go into sort of like...
There is Tesco, but it's not big like it used to be. So, for example, 9 years ago when I used to still live in Poland, it was big.
Yeah.
Really big. But nowadays, it's not.
In Europe, it would be Lidl.
Lidl,
Lidl like everywhere.
Lidl's gone really on top, and we've got our Polish store as well, which is really famous all over Poland. So I think this one is taking over a lot.
Yeah. Well, I think
it's not here.
No, whereas at the they'll start to retract now. There's the big supermarkets because as the others come into the marketplace and the market share. So again, it's a case of looking at those things, which is all key for ratios, because it's a case of looking at what factors affect the ratios as we're going along. The external factors. Okay. All right. So then we can compare it against industry averages. So we can look at what's going on in the industry, because that's what we do in education. Because the Skills Funding Agency will pay us money to educate students and to take them through courses, but what they do now is they will look at if you're not succeeding and your students aren't achieving, then they're not going to pay you, and they'll only pay you to the colleges where they are earning money. Okay, so that's we're all governed by what's going on as benchmarks and where we're up to. Okay, so it's important to understand the relationship. I just said there, so why has our gross profit margin increased yet our net profit margin has decreased? And I just asked that. Let's say, for instance, your sales go up. Okay, your gross profit margin goes up, but your net profit margin goes down. Why would that be, do you think? What's between gross profit and net profit on financial statements? Gross profit minus equals net profit. Expenses, isn't it? So therefore you can be in a situation where your gross profit's gone up, your sales have gone up, but your net profit's gone down because your expenses have gone up. So there's usually a relationship, well, there's always a relationship between the ratios as to why has that happened. Okay? So again, we'll look at that as time goes by. And that's basically just that. Equally, you can be in a situation where your sales have gone up, yet your gross profit margin has gone down. What do you think that's usually to do with? What's between sales and cost of sales? So what do you think within cost of sales could impact on the gross profit margin? Purchases. It's costing you more for your stock. How's that happened? My sales have gone up, but my gross profit margin's gone down. But then you look at your purchasing and you go, bloody hell, it's costing a lot more for our goods. So again, there's a reason why the ratios have changed. And that's a great thing about them, because you compare in a couple of years and you're identifying what's actually going on in relation to those things. You'll see them as we're doing in a minute. Okay? This is from Kaplan. These are on these slides as well. So you'll be looking at these as well as the Osborne when we start doing the questions short. Okay. So we look at profitability ratios, and in particular, a key one for the exam, that will be in the exam because they always are, is a return of capital employed. Okay. And return of capital employed is your profit, so your profit from your operations, over your total equity plus your non-current liabilities. So what we're saying is what profit have we got from the assets that we've got within the business, okay, from the capital that we've put in the shareholders, plus the loans that we've borrowed for the business to keep it going. And we're saying, so what is the return that we're getting for all of the money that we've put in, okay? And again, if I'm putting like, I don't know, 30 grand into a business and I'm getting sort of like 12-13% interest, is that good? Is that good, and how would I compare it? What would you do? Thinking outside of accounts now, I'm just thinking of business. Now, as a business person, if I'm putting 30 grand into the business and I'm getting 11% out, and I'm saying, is that good? What would I compare it against? Apart from other companies, what else? I could put it in the bank. If I put it in the bank, I'll probably get about 5%, so that's not bad. It'd be a good return. So it's all right. I could put it somewhere. So you're looking at what rate of return you're getting out. Or I could put 30 grand into the business and I get 3% out, and I think, bloody hell, I might as well put it in the bank and got 5%. So it's like comparing to see what I've got. And the return of capital employed is a key ratio, because it's basically saying, for what I put into the business, this is what I've got as a return. Okay? And that's what we're looking at when we're looking at return of capital employed. Okay? We then do return, there's a few, but return of shareholders fund. So profit after tax, so your old net profit, against total equity. So for the shares and the share capital, so on and so forth, what return did we get? So again, it's what have I put into the business, so like from the capital, and what return are we getting as shareholders based upon the monies we've put in. Gross profit, as I said before, gross profit is over revenue. So again, I said before that gross profit over sales, as it used to be, but gross profit over revenue, as I said before, that in relation to the off-licence trade, it's like, if my sales were £10, and my gross profit was £4, then there's your 40%. So you're looking at what your ratio is as a gross profit margin. Net profit margin is just net profit over revenue. Okay, so it's just looking at what you're making overall. I did say this previously, I can't remember whether I said it in your class, but I do remember many years ago reading that John Lewis operated on something like 1.5% net profit margin. So a really low net profit margin. I did look at Asda's the other night when Ollie was doing his homework the other night till 10:30. I thought, well, I'll have a look at Tesco's financial statement. Looked at their net profit margin, 5%. So they're making 5% net profit margin. Okay, it's the volume where they make the money, which is what I'm thinking. But they don't make that much overall, sort of like profit-wise. Yeah, because of their expenses and other things as well. We then look at expense to revenue percentage, and it gives you a dash, and it'll do that in the exam, which means divided by, and that's why it's saying it like that. And I think I've definitely mentioned this before. I'll just remind you: revenue specific expense over revenue is what I did years ago. As I told you as well, I spent £1,500 to find out about pushing ACCA courses. Remember me saying? No? Well, that's it. I forget because I'm old, but I remind. What I basically said, AAT have a service where they will tell you, basically me, of how many students within the Greater Manchester area are on a level 4 course, as an example. So in Oldham, in our level 4 classes, you used to have probably about 20 in the day and 20 in the evening. And then basically you had Tameside, you had Bury College, you had all the colleges out the north. I could have done them all over the place if necessary. But we're thinking we're going to do ACCA next year. So what I want to do is I want to send out some marketing literature to AAT level 4 current students who are on a course within Greater Manchester. So AAT will provide us with that information if necessary. They charge us £1,500. So we spent £1,500 to do a mail shot of all of AAT level 4 students in different colleges within the Greater Manchester area. And do you know how much we got back? Not one. So it didn't work. I don't think, we didn't get any that year. There wasn't anybody that came and said, oh, I got your brochure about ACCA and that's why I've come to the course. None of them did it because of that. It was more so progressing some more existing students. So looking at that, because you should always look at what have you got for the money that you put into something. What did I get out of it, like cost-benefit analysis? What did it cost me to get that money for that return? In that example, it was very low because we didn't get anything out of it. Okay. So look at that, and then the operating profit percentage is quite similar to one across the way. So what again? Shows a profitability taking into account expenses. A change may be due to increasing costs, and again it could be to do with sales. There are many factors that could be the reason why the percentages are changed. Okay. Return on capital employed, I said a minute ago, is the profit of a company in relation to the capital employed. So the percentage return can be compared to other investments, as I said before, like a bank, so on and so forth. And I think it's about 5% if you look at these days in a bank account. You get a rate of return. So what could you got a better investment elsewhere? You'll see this going along later, but it says the return on capital employed for limited companies must take note of different methods of financing when calculating the capital employed, because the capital employed for limited companies is basically where do we raise our monies from. Okay, so with that you've got, and you'll see it in the financial statements where you've just got total equity, which is your ordinary share capital in your reserves, and then you've got your total equity plus preference share capital if you've got any. So at the bottom of your, it's in the middle now, isn't it? We use it at the bottom of your balance sheet. And then any non-current liabilities such as loan equals capital employed. So again, it'll be far easier when you're doing the ratios because you'll be able to pull all of that information together, which is what you're going to do now, I think. So I've given you Wyvern Trading Company, and I'm going to give you Falcon Limited to look at return on capital employed, operating profit percentage and gross profit percentage. So you use Wyvern Trading as your guide and the ratios that were in the PowerPoint slide, and then you're going to calculate the ratios with reference to Falcon Limited. It does actually do all the ratios on there, but I don't want you to do them yet. I just want you to do the ones that are on the board, because we'll tackle the other ratios in a bit. And whilst you're doing it, I'll write them up on the board. Just so you know, I'm going to move on. Okay, just so we know where we're at. Key thing about ratios is certainly in relation to profitability. Just note, a lot of the time, you think I can't remember the ratio. A lot of the time it's against the revenue. So look, for three of the ratios, it's the same bit, and then you just look at the financial statements and you relate it to the revenue. So it might seem as if it's a lot, but it's not really. It's just a case of identifying, because it tells you in the ratio of what it's asking for. It's just being able to identify it. Okay? Return on capital employed is just one that sometimes causes an issue. But again, it's just a case of familiarising yourself with what it's asking you. And it's saying, so what are you getting out of the return that you're putting in? So in relation to the analysis of, we'll just have a brief conversation about it. If you're writing this up in an exam, you would state the obvious. And you would basically say that revenue in 2000 let's have a look, say operating profit. Revenue in 2007 has gone up from 425,000 to 525,000. Whereas profit from operations has gone from 41,000 to 53,000 pounds, going from 9.65 to 10.1. And you're just stating I know that sounds daft, but you're just stating the obvious about what's happened. And then you could then go into the analysis of why is that, okay? And sometimes you can see it might be to do with cost of sales going up, or it might be to do with other factors, all right? But we'll analyse that much more later when we go into it. I put net profit on there just as an additional one, because, again, it's like in relation to that, what I'm saying is they've gone up pretty similar, really. Your gross profit percentage has gone up from 14.35% So you're making £14.35, yeah, in the 100 as such, right? So you're making 14 quid. And then you got going up to 14.95. Quite similarly, really, so there's nothing major there. I just threw that in as an example, okay? So you just understand the basic what the impact is. And I said before, that if you're in a situation where your net profit, so your gross profit percentage has gone up, but if your net profit percentage has gone down, then we said before that's usually to do with expenses, okay? Because if your sales have gone up, your gross profit's gone up, but your net profit's gone down, that can only really be to do with your expenses going up. You've had a big expense of some kind, okay? So again, that's it in relation to profitability, and we will cover a lot more of those as we're going on. So we're on to the next bit, which is liquidity. Okay, so I'll rub that off. So liquidity, as we say, is cash and access to it. Okay, key ones as far as we're concerned, so will be the current ratio and the acid test ratio, otherwise known as quick ratio. So basically say liquidity ratios measure the financial stability, stability, in any sense. Is there such a word as stability?
No.
So stability. The company, in other words, the ability to pay its way in the short term. So main focus of attention is on current assets and current liabilities. So we look at the current assets of the business against the current liabilities. And as I said before, the ideal situation for current assets as a ratio would be what? No? What did I say was the ideal ratio for current assets? What would be the ideal, I said before, what would be the ideal ratio in relation to your assets against liabilities? I don't remember. That's what happens at age. Can you remember? See, she's far younger, so she remembers. For the tape, I'm only kidding. So liquidity is basically looking at how safe are we in relation to, as an investor, if I'm going to put money into the business, is it going to be safe in relation to, just out of interest, just as a reminder, what are current assets? Can you remember what they are?
Stock.
So inventory is one of them, isn't it, which we know?
Cash.
Cash at bank and cash in hand and all that stuff. Do cash and cash equivalents, as we say.
Debtors.
Yeah. So all of those things, okay? And it's, I don't know if we do it now, when we do these, but remember we said we do it in order of liquidity. See, when you do it on level 3, you'd have done it in order of liquidity, wouldn't you? So under your current assets, what would be the first? Least liquid, going down. So your last one would be cash and cash equivalents. Can you remember what would be your first one in relation to your current assets, Emily?
Do you debtors?
Sorry?
Have you got
From that now. Just for you, it's got your name on that.
I was going to say you
Cash and cash equivalents is the one which is the most liquid. So on the financial statements, it goes on the current assets. It goes as the last one. So out of your current assets, what is the least liquid?
Debtors.
Debtors?
Stock.
Stock. How quickly can we turn it into cash is the key thing. So if our investors come and say, I want my money, then it's a case of the least liquid is inventory, isn't it? Okay? I'll explain. So we go inventory, debtors, bank, so on and so forth, prepayments or whatever the case may be, or whatever you've got, trade receivables, so on and so forth. Okay. I'm just showing that as an example because it comes in handy for the next one. As far as your current ratio is concerned, the ideal ratio under the current ratio is 2 to 1. So you've got twice as many assets as liabilities. That's the ideal situation. Okay? So how safe are we? What we do with the next one, which is the acid test ratio, or the current ratio, or the quick ratio, the different terminology, is we now take inventory off, okay? Because as an investor, or as somebody who wants to get my money back from my customers, or whatever the case may be, if I go back and say, "Listen, I want my money back," okay, they've got twice as many assets as liabilities, so I feel fine about that. But we take stock off, because what would happen if I'm going for my money and I say I want to get my money back? Then you say, "I've not got any money, but you can have the stock." I don't want the stock. I want money. Whereas debtors, we don't include that, because debtors, you've already sold the stock, you can chase them up to get the money back. So what we do is we take stock off, because stock is really something that your creditor's not really going to want, because they don't really want that, they just want the money back. So what we do is we take the stock off. And again, in relation to that one, the ideal situation for that is 1-to-1. We've got enough. Just let me ask you another question. We said before that your current assets is 2-to-1 is an ideal situation, twice as many assets as liabilities. Would 3-to-1 or 4-to-1 or 5-to-1 be any good? Do you think? Would 5-to-1, 5 times as many assets as liabilities, would that be good? What we do when we look at that is...
You've got stock, but you're not selling them.
It could be the fact that might be the situation. It could be that we've got money tied up in stock. We might have so much assets. A lot of it might be our stock has increased so much and we've tied up so much money. But equally, it could be other thing. Could be our debtors has increased significantly. So we'd need to chase them up to the money. So it's not necessarily good having such a high current ratio, because it might be you're not controlling your resources particularly well. You might be able to do better things with your assets as such, okay? So it does say to show whether the business can cover its liabilities from its current assets, as it says before. So what I want you to do now is I want you to go back to that question we were just doing, i.e. those financial statements of Thingamajig, Falcon, and I want you to do the current ratio. I don't think you can do the current ratio and also the acid test ratio. And I'll do them on the board if I should do them. What we're doing in there, you've got all the ratios. First thing we did is we did profitability. So you've got Y there, that's Y there. This is why they encased it. It has the financial statements, and then they produce the ratios. We did those profitability and liquidity. Okay, so we're doing this is a case study that just explains how we calculate the ratios as well. And now we've got the ratios at that level to see what you do. So we did we've done the profitability ratio. We'll come back to them later. Now we're doing the next one, which are so the statements of financial position. And do those. So what does it mean? What do we say? What does it mean, Pauline? What's happening between 2000 and 2007, 2008?
The current ratio has gone down.
Yeah.
Both of them went down.
Well, both of them gone down, haven't they? But again, as far as the actual the current ratio is concerned, you say it was 3.2. So 3.2 times as many assets as liabilities in 2007, coming down to 2.5 in 2008. We could look at the accounts and we could determine why is that, what's happened. Could be to do with overdrafts. I think the overdrafts have gone up. So have overdrafts gone up?
Bank overdraft has gone down.
So bank overdraft?
No, from 2007 to 2008.
Yeah, it's the other way around on that, isn't it?
Yeah.
So we can have a look at that and see what about our debtors? I think they've changed as well, haven't they? Trade receivables, have they gone up?
Yeah.
Yeah. So we can have a look at them and we can determine basically what the reasons for that would be. 1:1 is the ideal, as I said, in relation to the acid test ratio. You'll get somewhere it's like 0.9, which means we've not quite got enough assets to cover our liabilities. Okay, it really does depend upon the business to a certain extent as well. The supermarkets have a quick turnover, whereas like engineering companies, they're a little bit different because they have a lot of assets that they keep hold of. So it really depends upon the business. But generally, as a general rule of thumb, 2:1 is the ideal for the current ratio, 1:1 for the acid test ratio. Okay? Any questions? Are you alright with that?
Yes, thank you.
Just going to finish off this next bit, then we can have a break. So I'll finish off all what we're doing first, and then we're going to go focus on the AAT questions, focus on the questions we've got in the Osborne books as well. I've printed off the activities for you, and then we'll be hopefully well armed. So that's Maxine, which is asking. Nothing. No wine. You're being very good. Calpol Froley. There we go. She might ask for wine later. But, okay. So looking at the resources. Okay, the next part to have a look at is basically about how do we use our resources, how well do we use them. In particular, it says how efficient does management control the aspects of the company. So the inventories, how well do we control our stock? Okay. Do you have any stock in your business? Is it?
You're not holding it.
No, it's just
Comes and goes out.
comes and goes in, doesn't it? There's nobody really. You don't have yours, are there? Certainly.
Yes, you.
Thank you.
In the off-licence trade, we used to fill the room like this at Christmas with beer. With like cases and cases of beer, and you fill it all and you think, bloody hell, that's never going to go, and it just goes. But when it comes to the sort of like end of March, being over towards the tax year, we used to run down our stocks, okay, because we didn't want to have too much stock within the shop, okay, because we used to run it down. And the key thing about it is really just about how you control your stock. Because the worst thing, as far as customers are concerned, is they get really annoyed if you haven't got the stock that you like. Okay, so therefore you've got to make sure that you don't have too much stuff. I'm just smiling because there was an old lady that used to come in the store, and again I might have said this to some people, that used to buy Benedictine. Do you know what Benedictine is? Mix it with brandy, but it's about £20 a bottle. And this old lady used to come in every week to buy a bottle. And one time we didn't order it, and she came in, she was really annoyed, so we used to get a case of 6, and we used to have this that she'd come every week, and sometimes she'd come in twice a week for this Benedictine thing. But then one week she came in, she wasn't feeling particularly well, and she was getting on, she was quite old, so I thought, I think we better cut back on our stocks. Why? Because you never know what's going to happen. There's only her that buys it, so so it's just the type of things you have to think about in relation to stock. If something happens to her, I don't want to be stuck with all this stock, do I?
People give it away at a funeral or something.
And one of our level,
No.
one of the day group, Emma, and she's on our. She's on the foundation degree, and she does level 4 on the foundation degree as well. She's not, but her son's going through so much shit at the moment with all these tests and all these things like that. And she's lost loads of weight. And I was saying to her, she said, I look at all these pictures, got all these electrodes all over because they're monitoring what's going on with him health-wise and everything. And she goes, I'm knackered. I said, the benefit is, you look so much better because of all the weight you've lost. Cost benefit analysis. She knows I don't mean it. It's just, I don't know why I'm saying that when I'm saying that. Stock, that's what I'm saying, isn't it? Okay. But point being is you have to control your stock, isn't it? Okay? So what we look at is how do we use it. So inventory turnover. So it says companies strike a balance being able to satisfy customer requirements of inventory and the cost of having capital tied up. On a Wednesday in here and a Thursday in here during the day, it's chocker. The queues at the canteen are mad. Okay, so therefore it tends to disappear the food by about 1 o'clock. Certainly if Angela's been there, because she likes the food. So it's basically you've got to make sure that you have enough stock. So inventory turnover is looking at how quickly you turn over your stock. All right? Then we look at the stock holding period. So what's the problem of holding on to stock for too long? What do you reckon, Andrew?
It depends on the type of stock that you hold.
Okay.
Obviously food goods would go out of date.
Yeah.
And they would be in waste.
Yeah, good.
If you're in the clothing industry, you might hang on to too many winter coats and then all of a sudden it's summer and you don't need them anymore.
Perfect. So it all goes out of date and it goes out of fashion and all of those, but then comes back at a later date. You know. But again, if your business is technology and things like that, the other problem about having too much or holding on to stock for too long is it ties up your money, doesn't it? So it ties up your capital, so you can't do anything because you've got this money tied up. Okay. Then you start reducing it to get rid of it and all of those things. So that's like inventories over cost of sales. And this one you notice that we do by 365 days. So we multiply, so we divide inventories, so our stock, divided by the cost of sales, so what did it cost us for it, times 365 will give us an average of what your stock holding period is, how long you tend to hold on to your stock. In itself doesn't tell you much, but against the other year it'll tell you more, because you find out that your stock holding period is increased, then it means maybe you need to look at the procedures that you've got in place in relation to that. Okay. We've then got asset turnover, so revenue over your total assets. So how efficient are our assets? So the assets that we've got at generating revenue. So how well, what job they do? They do a good job of generating the revenue. Okay. And then we look at trade receivables, collection period. So your trade receivables in old money, your debtors, over your revenue, times 365. Will tell you basically of how long it takes you to receive your money from your debtors. And again, we tend to still work on the basis of 30 days for our customers to pay us, for our debtors, and 60 days to our suppliers. Okay? That example that I'm giving you to Falcon Limited, you have to do trade receivables, but I'll ask you to do trade payable because it's daft, but I'll explain why when you've done it. Because one of the things that you need to do when it comes to trade receivables is you compare it with your trade payables, because you don't want to be in a situation where your customers are paying you before you pay your suppliers. Because obviously the whole point of credit is that if you do 30 days, you get 2 months worth of money in from your customers before you pay your suppliers. But when you look at the ratios sometimes, you find that they're a bit too close. Okay? So let's say, for instance, if it's 30 days is an average like we get money from your customers, yet it's taking 52 days, then what's the issues in relation to that? And what will we do about it? Andy, what do you reckon?
Sorry.
So if your customers generally normally take, say, 30 days to pay you, and then you do your analysis and it turns out they're taking 52 days, then what's the problem with that, do you think?
You're not getting your money as quickly.
You're not getting your money as quickly, so what would you need to do?
Chase up.
Chase them up.
For a late payment.
Yeah, you tighten it up, don't you? Because basically you find that when you're looking year-on in comparisons, you'll see that maybe that your trade receivable collection period, it increases, means it's taking longer to get your money. So therefore, so the action would be then to chase up your debtors to get them to pay. Okay? And then your trade payable, what's the problem of paying your suppliers late? Do you think?
They won't supply you goods.
They don't want to supply you goods, do they? If they give you 60 days to pay and you're paying about 72 days, then they're not going to be happy. Are they really? Because they want you to pay as quick as you can, which is why they'll offer you settlement discounts and all of those things, because they want you to pay quicker. So cash is king and all of those things are said before. Okay, so we'll look at that, and then we've got working capital life cycle, have you done that before in any of the parts of the course? The working capital cycle is basically your stock, your receivable days and your payable days, and you're looking at how quick it is that you receive your stock, to basically to pay your suppliers some more stock, to when your customers pay you. So it's managing that cycle to make sure that you don't go out of sync, i.e. that you're getting your money in time from your customers to pay your suppliers to bring you in stock. So it's making sure you control that cycle to make sure you've got enough stock within the shop. I said this before because that's a key example about that friend of mine who exports all of those sweets from Turkey and all of those things. You know, he's got the sales there, but he's not got the money to be able to buy the goods. Okay, so therefore he can't fulfil those sale commitments because he can't buy the stock. And sometimes you get in that situation again. We saw it certainly in the independent off licence where we didn't have the money to buy the stock. Sometimes you have to wait until you've collected the money, and then you can go and buy the things that you need to buy. So it's quite a difficult match to try and match those things as they go along. Okay. Asset turnover, so again, revenue as opposed to your non-current asset. So in other words, like how efficient are our fixed assets, such as our machinery, such as our buildings and so on and so forth. So how good are they at generating revenue for the business? So are they, again, you look at the year, and again it's a time, so looking at what's the ratio in relation to the assets and the thing. We'll finish off the slide. We'll tackle those in a minute with that other questions that we've got. But I'm just going to finish off with the final one, which is looking at the financial position. And again, we'll cover these ratios all together. So this one is looking at, as I said before, sort of like interest cover. So financial position looks at your profit from your operation. So what profit are we making in comparison to our finance costs? So your finance costs that you'll see in your profit and loss account. So what are your finance costs in comparison to what is your profit? What's that telling you, do you think? What do you reckon? So profit over finance costs. It does say that, but you're going to read it verbatim now.
Yeah, because I can't quite seem to get it straight in my head what I want to say.
It's sort of like a ratio. So what we're saying is that how safe are we in relation to our finance cost? So if our interest payments are £1,000, yeah, and our profit is £5,000, then it's 5 to 1. We've got plenty of profit to pay our interest, so we're safe. Okay, but if your profit from operations is £1,000 and your interest payments are £1,000, then it's not safe, is it? So you're saying how safe are you in relation to paying your thing? So again, if you're an investor and you're going to look at putting money into the business, and you think, right, the profit was that, but look at what the interest charges are. They can only just afford to pay their interest payments. Okay, and again, I have seen that before with a bloke I used to work with when he bought that brand new Jag. He had a brand new Jag that looked really nice, but he couldn't afford to put the petrol in it. So it might look nice, but if you can't afford it, then you can't afford it, can you? But again, so we're looking at how comfortable are we in relation to paying off our finance cost. And then I said to you, gearing, which is a key one, is really look at, and this will be in the exam as well, is you look at your non-current liabilities, otherwise known as, on your steps of financial position. What they used to be called something else.
Fixed. Was it fixed? No.
Bank loans and things like that, isn't it? Or your debentures. So your non-current liabilities, current liabilities are your trade payables and all of those things. Whereas your non-current liabilities is your bank loans or your debentures of how you raise money for your business. You know that on loans as such. Okay. So what you've got there is your loans over your equity. So the equity that you've got within the business, but then you add the non-current liabilities as well, because that is something that again you're using to keep the business running. Okay. So then what that tells us is basically about how again, I suppose how safe, but how comfortable that organisation is in relation to their debt. And what I was saying before is that an organisation that has a gearing ratio of 50% means that the business is basically running on 50% debt. Okay? So as an investor, you do the gearing ratio, you think, I don't know whether I'll invest in that. And they do say that football clubs are, if you look at the gearing ratio of a football club, it will be massive, it will probably about 80-90%, because it's very much based upon debt, isn't it? Yeah, because the owners of the business and all of that, they never make a profit, which is why they're bringing out these fair rules, okay? Because they're very much based on debt, not a really good investment model, to put into it. They rely upon rich owners. Don't help City last night, but didn't. Okay, so that's that in relation to that. I'm going to leave limitations till later because we'll do the ratios in a bit. So it's 1:15. Can I have a break till about 1:30 or something? 25 to whatever, I'll just carry on. But then we're going to go to that Falcon Limited, you're going to apply those ratios. You're going to look at trade receivables, you're going to look at the rest of those questions it's asked you to look at. Alright? And then that'll be it. And then I'm doing it very much focused on what we need to do for the assessment tonight as well. So then we're going to do the AAT papers, go through both of them together so that you understand what's required for the AAT exam. Okay? I'm going to get coffee. Is anybody want one? I'm only joking. Part 2. So AAT's practice paper on the AAT website is sample assessment 2, and this one is where you need to analyse it in much more detail. And again, so what we've got here is it says you're employed by Sing Limited as a financial analyst. And you're being asked to look at the profitability of the interest cover of the company over the last 2 years. You have calculated the 3 key ratios for Sing Limited in respect to its financial statements for the years 2001 and 2000 XO. And an extract from the company's annual budget for 2001 is also provided below. Then it says, so comment on the relative performance of Sing Limited in respect of the 2 years, giving possible reasons for any differences based upon the ratios calculated. The extract from the annual budget may assist you in some aspects of it. It does, and it's key in relation to this question as well, okay? So the first thing we're going to do when it comes to answer that question is we're going to look at the gross profit margin between 2000 and 2001 and actually state that the gross profit margin between 2000 and 2001 has gone down by, so we're getting points for doing that. First of all, we've noticed that the gross profit margin has gone down, and secondly, we put the amount that it's gone down by. That sounds common sense, but a lot of students don't put it. You don't state the obvious. You get points for stating the obvious, okay? Gross profit margin has gone down, okay? The next key thing in relation to that is I would advise you, if it is a budget question, to do what the ratios would be based upon the budget. So for example, what's happened with operating with gross profit? 38.9 in 2000, 31.6 in 2001. But the actual budgeted gross profit margin was only 33%. Okay, and I'll show you, because I'm just going to do it in relation to this paper now. So you've got your gross profit margin, which is, so your gross profit, which is 310, over your revenue, so your sales, 940 times 100 equals 33%. Okay? So basically what we're saying is that we expected our gross profit margin for 2001 to be less than 2000 XO, but we expected it to be 33%. So it's less than what we budgeted it to be. Because we only expected it to be 33%. It's worse than what we thought it was going to be. Okay? And you're going to have to do that for each of the questions by stating the obvious and then working out, so how is this in relation to budget? I do know, because I've done it before, when we come to look at operating profit, it's pretty much the same. So in other words, the budgeted operating profit for 2001 is also 11.3%, so therefore it's in line with what we expected. Okay? So that's what you do, you're just stating the obvious and working out any differences between them.
What was the second one you said?
The other one is the operating profit.
Operating profit.
Yeah. So the operating profit, if we look at the budgeted one, so your operating profit is your profit from operations. So is your profit from operations, which is 106. Okay. Again, divided by your revenue, imagine, by your 940. Again, like I was saying to you a minute ago, a lot of it's to do against revenue, and it's telling you where it is. Your profit from operations, or operating profit, is that, and it's against your profit, which is against your revenue, so it's always against your revenue. So your revenue, yeah? So it's just putting the figures in there to calculate it. So that one is 106 times 100 equals 11.3%. So we're budgeted for our operating profit to increase from 9.2% to 11.3%, and it falls in line with what we expected in relation to our budget. So there's like 3 points to each thing, isn't there? So state the obvious, it's gone, our operating profit in 2000 XO was 9.2%, increased to 11.3% in 2000 X thing. That is an increase of, and I mean that to that detail. Okay, so the difference between them, which is 11.3%, with reference or in relation to the budget, it also falls in line with what we expected, because we expected our gross profit margin for 2002 to be 11.3%, and that's in line with. Okay, so that's what you're doing. It's 23 marks for this question. Well, let's just have a look a little bit more about it, what it's saying as well. So why is that? Okay, so we could have a look at that. So why is that the case? So let's have a look at the first one. So our gross profit margin has gone down from 38.9% to 31.6%, less than what we expected it to be. So forgetting about that bit now. So why would our gross profit margin go down? Do you think? How do you calculate gross profit margin?
Gross profit from operation.
Gross profit margin is your gross profit
Or divided by revenue.
divided by revenue. So what would make your gross profit margin go down? 2 key things really.
Reduction in revenue.
Your sales have gone down, so a reduction in revenue. So you're basically explaining what that could be. Another reason?
Your cost of sales could have increased.
Your cost of sales could have increased. So again, that's the full marks for that. You know, just by noticing those 2 key points of what that's going to be. Okay.
So what was the first one? Cost of sales might be increased and the first one.
Well, we're saying that your revenue hasn't increased. Your revenue is decreasing. So your revenue is decreased. Okay, let's have a look. So again, if you look at the other one in relation to operating profit, so again, operating profit has increased, which is good. So why would that be? So if you look at the operating profit and what the format of your operating profit is, and look at how you calculate it. Let's have a look. Operating profit or profit from operations. Better control of your costs. So your gross profit minus your distribution cost admin expenses gives you your operating profit, or your profit from operations. So what did we say? So why would that have increased? So how does the operating profit margin increase? So gross profit minus your expenses equals your profit from operations. That's before interest and tax. So what would that... What's the thing between those, between gross profit and operating profit?
Expenses.
expenses. So why has our operating profit margin gone up? Do you think?
Expenses from
Reduction
having
in expenses.
Yeah, which also can be to do with a better control of your expenses, isn't it? So your admin expenses, your distribution costs, you've been able to manage them and control them better, which has resulted in, 11.3% increase in thingy. Okay? We'll state the obvious and then think about what's what. Alright? And interest cover has gone from 3.9 times. Let's have a see what the budget was. So your interest cover what's the form of your interest cover, do you remember?
profit from operations
Yeah.
divided by finance costs.
I've not done that one, so what is it just out of interest? I didn't do that calculation, what's it?
4.6.
4.6. Okay. So in 2000 XO, we had enough profit to cover our finance cost by 3.9 times, and we expected that to increase by 4.6 times according to our budget. But it's even better than that. It's gone to 5.2 times. So we've got 5 times. Our profit can cover our interest payments 5 times over. Yeah, we've got enough profit to cover our interest by 5 times over. I'm just trying to see. So why would that be?
Sorry, what did you say?
So why would that be? That's an interesting one. Let's just think. So finance costs are what? Just out of interest. What are finance costs?
Interest.
Interest. Okay. So therefore, what would be a reason that we can cover our interest cover better, or we've got enough more profit to cover our interests? Why do you think?
Could it be something like, depending on the loan agreement that you've got in place, is that your interest rate could have changed
Yeah.
in line with the Bank of England base rate? Or whatever?
Yeah, or just generally that you've got a favourable rate, and the interest rates have gone down. So therefore, because interest rates have gone down, it means that you've got more interest cover.
Yeah.
Yeah,
But also, if you've
and your profits increased.
yeah, your profits increase, but your annual percentage rate would overall come down on the cost of the loan because the loan's increasing because you're making payments to it. Does that make sense?
Yeah, if it's that type of a loan. Yeah.
So your rate might still be the same, but the amount of money that you owe is reduced.
So therefore, your
less
interest has gone down. Yeah, could be. Yeah, unless it's a fixed amount. But there's a few for it. As long as you can argue your point, then it's a sensible point, then that's fine, isn't it? Okay. So you've got the other paper, which I've given to you. We're going to go through this time and time. We're going to have left 3 weeks for just revision, so we're going to hammer this until we're blue in the face, as you say. So, well, you've got the question 1. So this is sample assessment 2. You've got sample assessment 1. So have a go at that one as well. So 7.21, and also the other side of that. I just need to go through something else, which will be very briefly, which is the final slide, which is to do with the limitations of ratios. So what's the problem with ratios, and what are those limiting things? And on the paper, I think the last question is about what are the limitation ratios, and the practice answers gives you about 18 different ones. So there's loads of them. They only wanted 3 in the exam. And what are the limitations of ratios? Okay. And on here we've got some. Okay, but basically, some of the key things, it's based on historical data. So what does that mean when we're looking at the ratios? We're looking at financial statements, aren't we? So when we say that ratios are based on historical information, why?
Based on information in the past.
Yes, because the financial statements that we're looking at have already taken place, haven't they? So it's based upon historical information, okay? Some of the key things are, what are pestle factors? Have you heard of pestle factors before? You might bring this into your project. Pestle factors are political, economic, used to be pest factors, political, economic, social and technological, legal and environmental factors that can affect the business. Ratio analysis doesn't take into account those factors. In relation to political factors, what does that mean?
Depends on the government and what kind of taxes they're going to put on new business and things like that.
If your business is in Syria, as an example, and you export there, or or if you're doing business with Russia, yeah, and now there's all the trouble with the Ukraine, and the government are saying, so the political influences on your businesses can be massive. Okay, economical factors are to do with economical things. There's a recession on at the moment, so people haven't got money, and be able to buy things, and businesses, it affects them as well. So economical factors can have a major impact. Your ratios don't tell you that, but then something changes, like there's an economical catastrophe, which means it's going to have a massive impact. Personal factors are those factors that have an impact on your industry. Further education is going to have another massive cut next year, so the Skills Funding Agency are cutting back again next year. So therefore, what's the consequences of that? To the college, apart from being, I think they got £3 million less this year than what they're going to get the previous year. So what's the consequences of that, do you think?
Because they're putting resources in
Such as?
education.
Yeah.
Anything from staff,
Staff.
reduce the amount of staff.
First thing they do is look at staff. How can we reduce? We're fine, Jack. I don't mean that in a lot, because our provision's growing. But other ones where it's not, they'll look at cutting and say, we'll get rid of that and we'll stop that. They're not taking anybody on as such unless you can justify it. Even I'm after another tutor, but they'll only let me bring somebody on a casual staff, which is fine. So just not a contract, because they don't want to get tied up with contract. So economic, social, what are social factors? BP, all of those. So social consequence, what people's social factors about what people feel about things that has an impact on your business. Co-op made their money all those years ago by being the ethical bank, didn't they? So they really tugged upon people's social strings, in a sense, so it's about people's feelings in relation to things. Do you know what I mean? So it's the impact that social factors can have. Technological is massive. So in all industries, technological advances can have a really massive influence on your business, such as? What do you reckon? Anything, think of any business.
Yeah, like updates in computers and things like that comes at cost, doesn't it? And things like that. Trying to think of things like that.
You can think about anything in relation to the phone business. Education is a key one at the moment, because I'll be honest with you, I was saying to the students today, do you see all these masterclasses that you see on the AET website? I don't know whether you look on your AET website, but they're offering training courses and all these type of things on the AET website. But the thing that really annoys me, it's iCount. They're a competitor of ours, or it's Kaplan. So AET are advertising courses for them to go on. When many years ago with Kaplan, a few years ago, still doing it, Kaplan sent letters to all of my full-time AAT students offering them apprenticeships. My students were coming, look, Kaplan, apprenticeship, offering us apprenticeship, try to poach your business, your student. What it didn't say about apprenticeships is that if you've got a job, there's a small print at the bottom, so the students come here thinking, I'm going to get an apprenticeship, and they go, you got a job? No. So they were misleading. But to me, honestly, AAT had a too cosy relationship with Kaplan, in my mind, okay? Because the courses they're advertising through them are competitive. But saying that, video technology, tweets and all of those things, they're important, because it's all changing the way that we do business, isn't it? Okay? Let's look at the AD. Legal factors, as the name suggests, or legal factors are something that happens, like in the pub business when they ban smoking, or legal things that has an impact on your business. Okay, for us, like safeguarding is massive. When I take the kids across the road to the media centre, you've got 1 million pieces of paper to sign and to complete, and get them to do a risk assessment and all that type of stuff. So all the legal things that you have to cover. But for your business, you have a massive impact on legal decisions that are made that affect your business. Okay. And then final one is environmental. Okay, so environmental factors, we talked before about sustainability. You know, it's a big, big area these days. They're talking about, like, car industry, isn't it? They were saying the other day that now they're not far off having batteries on electric cars that are going to last a lot longer than the current ones do. So, as was the case, so batteries being that big, now that big, and then they're getting smaller and more powerful. So they're very close now, where electric cars can drive a lot further than they used to. So if your business is petrol, or if your business is something else, then environmental factors are really massive, aren't they? That's also to do with a bit, because sometimes we relate to social, because environmental factors like McDonald's and, you know, all paper all over the place, you know, because and mice and rats and all of that, because they've not looked after the environmental side of things. You know, they don't recycle the stuff, and they just throw all the stuff out. Okay, it's all important factors. They're limitations of ratios, because we don't take those into account. So there's a lot there you could talk about in relation to limitations. Apart from those, so this is saying, be very mindful of seasonal trade and year ends, and often the seasonal trend is over when the business is at its best. So in other words, they plan things so it looks all nice. So just be aware of manipulation in relation to the account. Window dressing, as it says there. Again, patient information that's already happened. Yeah, so in other words, you've got to be able to compare it, haven't you, with other businesses as well. So what's going on? Ratios in itself are good, but you've got to have something to compare it with other industries. Is that alright? Good. That's it. Unless you want to stay. Do you have a late one? It's alright, that. So 7.21, and have a go at that other paper, please. And then we'll start off with that next week and then go into consolidation. And then we're not far away.